Welcome everyone to this special webinar on GST by ET Rise. So, as we all know, we taxpayers need monthly compliances when it comes to GST. But it's just not the monthly compliance that you need to look at. You also need to file your annual returns, and today's webinar is especially towards this annual return. It's new, it's not something that you've seen before, and along with that, you need to audit those annual returns as well. Joining us today is Priyajit Ghosh from KPMG India. And as always, he will first run you through a presentation which talks about the annual return, scope, how it looks like, things that you should keep in mind. And followed by, as usual, we'll take question and answers from you guys. So please feel free to ask your queries, and we'll try and get it answered. So, Priyajit, please take us through what you have today.
Thank you, Pran. So the way you want to structure the discussion is into two parts. First, the very basic as to who needs to file, what are we going to file, and by when are we going to file. And of course, if we don't file, what are the consequences? Then we will move on and see as to what we need to file. And we will go on to each and every cell and explain you as to how do you get the data, and also tell you as to the typical challenge that likely to arise when you start collecting the return. Now, before I get into any of those, I think the timing of this webinar is very crucial, and I'll explain you, because we just have 3 more days before a lot of the activities are going to get over. And often the misconception is that you can kind of postpone your filings. You can do all the adjustments even till the time the annual return is going to get filed. So that's not happening, and that's a big news, and that's some surprising news. So we really have some steps to be taken before the month ends, and certain filing happens in the month of October. So we're going to talk more about it as we go forward. So first thing first, who is supposed to file it, right? Now, everybody who is registered under the GST needs to file it, which means, of course, people who are not registered under GST, they don't need to file it. But to make it very simple, everybody would need to file it, and there are only few exceptions to it. The exceptions are the input service distributor. What is input service distributor? Which means you just have a registration to transfer the credit from one state to the other, and you're not making any kind of supplies out of that state, then you don't need to file annual return. Then if you're a person who is only liable to deduct tax at source, right? So basically those government department, public sector undertaking, not in fact public sector undertaking, but more to do with government departments who do not have any taxable supplies, they don't need to file it. And any casual taxable person or non-resident taxable person. So clearly, everybody who is into the business in India would need to file it. And the exceptions are only meant for those cases where the registration are only to do certain set of compliances, but nothing to do with payment of tax. So everybody would need to file it. What do we need to file? And now there are some bit of a confusion around this. I'll clarify this. There are 3 returns that we're going to talk about, and that's 9, which is for regular taxpayer, 9A for the composition taxpayers, and 9B for the e-commerce operator who are deducting tax. So let me kind of structure a little bit differently. This is what we always understand. If you are an e-commerce operator who's deducting tax, you need to file 9B, which has not been notified yet. So we cannot talk about 9B because the format is not yet out. If you are a composition taxpayer, then you need to file 9A. Rest everybody files 9. Right, so 9 is going to be relevant for a vast majority of people who are paying taxes, and of course the balance is going to be 9A for composition taxpayers. When is it required to be filed? It needs to be filed by 31st December, which means 31st December 2018 for the last year, starting from July 2017 till March 2018, and any failure would attract a penalty of 200 rupees per day, subject to a maximum of 0.25% of the state turnover. Now, the late fee is it's not a discretionary penalty, which means that every day of delay is going to be 200 rupees per day. This is a timeline as per the government law, as per the law. Let's see if they end up extending the timeline, because all of it is not live now. But we still have a purpose to kind of explain you all of this, and this is going to be exactly what my last slide is. Next slide is going to be. Now, in addition to the return that we're going to talk about, which is 9 for most taxpayers and 9A for the composition taxpayers, one would need to file a copy of the audited annual accounts. Now, copy of the audited annual accounts means whatever that you get audited from your auditors from a company's laws perspective. So, audited accounts, and we are not talking about GST audit here, and also a reconciliation statement which needs to be certified by an auditor for GST, which is often referred to as GST audit report. So that has to be in 9C. The format got just released, and that needs to be filed only in a situation where your pan India turnover exceeds 2 crore. So let me repeat: everybody needs to file annual return. The exceptions are very few. 9A for composition taxpayer, 9 for the regular taxpayer. What are you going to submit along with the annual return? The copy of audited annual accounts or certified by your auditor, and also an audit report, which is often referred to as a reconciliation statement in the form 9C, only if your turnover exceeds 2 crore. If your turnover doesn't exceed 2 crore on a pan India basis, you don't need to worry about 9C. All that you need to file is audited accounts and GSTR 9 or 9A, as the case may be. Okay, so in the next slide, what we have done is we've kind of explained some of the key features, and these are very surprising, and we get quite a lot of conceptual doubt around these. The first thing that we need to kind of recognize is there is no scope for filing anything additional. There is no scope of filing anything additional other than what has been already declared in a monthly return. Which brings us to a question that why do we need it at the first place? And I'll go and explain why do we need it. But what needs to recognize is that it can also happen that I have missed out an invoice in my monthly returns and I want to now include it in the annual return. That's not permissible as per the format of the return. While somebody can really mathematically rolling it up to any of the rows, but that would lead to a mistake or maybe incorrect reporting insofar as the description of the report is concerned. So all of it needs to be reported in the monthly returns. And we're going to talk about special cases where somebody has missed out reporting a particular line item. How do we handle this? But clearly, everything pertaining to July till March, which is the last year of implementation of GST, needs to be reported by September 30th books, which means we still have 2 days. If you think there are certain credits that you have not taken, if you still think that there are certain credit notes that you need to issue, if you still think there are invoices that needs to be adjusted, that you should do it in the month of September, which gets reported by 10th insofar as the invoicing is concerned or the output liability is concerned, and again 20th insofar as the credit is concerned. Again, I will repeat this. Everything needs to be reported by this month as far as credit is concerned, as far as credit note is concerned, as far as the invoicing is concerned. And the last day to report is the next filing, which is 10th for the invoicing and 20th for the credit. If you miss out on any credit, which means you forgot to take a credit, the invoices were misplaced, you discover it after filing the return for the month of September, the law clearly says that those credit will not be allowed. Or in fact, the law says that credit would be only allowed if you report it in the month of September. And that's all the aggregate of information which the annual return is seeking. As we go down deep in the format, we'll realize that that's what they are asking us. The other part is, of course, no tax, no interest, no late fee, no penalty can be paid through annual return. Annual return is just a reporting mechanism. It is not a mechanism to pay tax, which again brings back to the same point that we just discussed a while back, that all tax payment, all reporting has to be done in a monthly return, and it's only a roll-up that's going to happen in the annual return or a summation that's going to happen in the annual return. The other part is there are certain requirements or certain data points which was not required in the monthly return, which is clearly going to be a point of work or a new reporting which is there in the annual return. and we're going to talk more about it. Like, for example, they are asking separate reporting of inputs, capital goods, input services, which are not there in 3B. Then there is some bit of reporting, extra reporting, which you will not even encounter in GSTR-1. So we're going to talk more about it as we go forward. The second last point is again an important point, and you kind of always wish that if you file the return once, can we really revise it? If you remember Tran 1, the Tran 1 revision was something that was allowed at a later point in time. The way the law is worded today, there is no scope for revision of annual return, which means annual returns, once it is filed, it cannot be revised until and unless they come up with a separate possibility of revision of return, which is not there. Okay, so there is one doubt which is there, which I kind of call out in the beginning, that you've heard that 9A is for the composition taxpayer and 9 is for a non-composition taxpayer. What happens if you switch the system, right? If you switch the system, then what happens? So we don't have an answer. Do you file 9A or do you file 9 or you file both? We don't have an answer, but possibly we'll get an answer. Having said that, we'll go through the tables, and if you look at the construct of the table, 9A and 9 are very similar, except 9 has certain information on input tax credit, which is relevant to those set of taxpayers, and it's not relevant to people who are going to file under 9A because they are under a composition scheme where the credit facility is not allowed. So we're going to go through the table in detail, and before going into the cells or the fields, we wanted to kind of give you an overview of the return as to what are the various parts or what are the subparts contains of, right? So the return is split into 6 parts. The first part is asking for very basic information, which is as basic as what is the financial year, what is your GST registration number, what is your name, and all of it. So pretty basic information. The second part is on the outward or outward supplies, which means all the tax supplies on which you are liable to pay tax. 2 types of supplies. One is that you're invoicing. Second is, of course, whatever that you're liable to pay under the reverse charge mechanism. So, like for example, the transportation of goods by road, the legal services where you're supposed to pay tax under reverse charge mechanism. Those are something that needs to be reported on part 2. To summarize, part 2 is all about your liability to pay tax. Part 3 is a credit related information, which means that you've already paid to your suppliers. The suppliers have charged GST. The supplier related information, more so the credit related information, is going to get reflected in part 3. Part 4 is the tax which has already been paid, declaration of tax which has already been paid, which means so you have the output liability, then you've considered the input tax credit, what you're left with is the tax payable, whatever tax that you have paid, that needs to be declared in part 4. Part 5 is about, now this is part 5 is a very interesting part, and when I was looking all of through, I perhaps realized why do we need any further part, because we've covered everything. But like I said, that you have a window till 30th of September to make all kind of adjustment pertaining to the last financial year, which is July 17 to March 2018. You could do it not only during the respective months, but also from April 2018 till September 2018. If you make any kind of an adjustment, which means that, let's take an example that I had an invoice which was issued on 1st of January 2018. Now, correctly speaking or technically speaking, I should have reported in the monthly return of the January, which goes in a February, or for whatever reason I missed it out. I can still report it in the month of September. And when I report in the month of September, we need to report it in part 5, because part 5 pertains to information pertaining to the last year, which are declared in the current financial year return, which is April to September. Now, please note that there is no extension or there is no facility to roll it over beyond September, which means you can't do it in October. If you do it in October, we'll talk about it, what are the implications, but as per law, it needs to be recorded by September. Part 5 is the miscellaneous information, and which are related to the demands, what are the supplies received from the composition dealer, what are the supplies from the what are the deemed supplies, a lot of the other information which really doesn't impact the liability, so to speak, but government will collect valuable information around this, and this is going to be used part of a broader analytics to see at each and every assessee or a geography, how these interesting data points connect to, and we're going to talk more about it, but clearly doesn't impact our liabilities as far as part 6 is concerned. So now what we have done is in the subsequent slide, and we just kind of debated a lot as to how do we best explain this, because while kind of going through each and every slide, some of the information are very obvious. Some of the piece of information we need to kind of tell you, call out separately. So what we did is we have created a mapping, because at the end of the day, we are doing a monthly compliances, and while doing monthly compliances, all the data points are reported into the return, which is GSTR-1 for supply and GSTR-3B for the input tax credit. So what we did is, apart from the invoices as well, so we have created a mapping in terms of what is the information, where do you get this information from, and what are the table numbers. So we do have a complete mapping available to us. I would kind of quickly take you through the particulars. So part 1, as we said, the first part is all about the supplies, and I've kind of excluded the uh, first part because first part is basic information. So we're going to start with part 2, which starts with serial number 4. Now serial number 4 is all about details of the advances, the inward supplies, outward supplies, which is declared in the return during the financial year. So all kind of invoicing, or everything to do with your revenue. Uh, it also includes certain expenses on which GST is required to be paid under reverse charge mechanism, which is row number G. In other words, row number 4G. And if you look at row number 4A to 4F, everything got recorded in GSTR-1, because you always supply information on your invoicing. All of this is to do with invoicing. However, 4G is the exception, which comes from GSTR-3B, because these are not really our supplies. These are the supplies of our vendors on which we are supposed to pay tax under reverse charge mechanism. So you construct 4A to 4G using tables from GSTR-1 and also 3B. Now, if you move a little forward, which is again continuing with the fourth part, serial number 4, which is the second part of the return, you also need to report the credit notes. And credit notes are, of course, for the price adjustment, the debit note, because what we are trying to arrive is the value on which tax was supposed to be paid. Now, column number, row number KL is very interesting. Look at column number K and L. K and L is all about the amendments. Now, a lot of times you would have issued an invoice, but the date of invoice needs to change. So everything that you have kind of uploaded the data, but you just need to make a correction. Sometimes people make correction more in terms of the address. Sometimes people make correction in terms of the taxable value. Instead of doing a credit and a debit note, you could also do an amendment in the return, which means reissue an invoice, and that is something which is required to be reported in the row number K and L. Balance everything else, if you look at above, it all comes from either invoice or a debit and credit note. After having recorded the revenue, the last line item is the advances. Because on services today, it attracts GST as and when you receive the advances. So the advances number also comes in, and that creates in total the liability to pay tax, the turnover on which there is a liability to pay tax. The next part of the table is about the outward supplies, where tax is not payable. Now, this is all about seeking deductions or claiming a turnover which is not subject to tax. And of course, one of the reasons why they are asking for annual return, when we go down further, we'll realize is that this clearly kind of summarizes the whole turnover in terms of what is taxable, what is not taxable. So if somebody wants to kind of get hold as to what is the total turnover on which you have not paid tax during the year, this is the table that he's going to look at, which is table number 5, and which is not available in the normal return because of the fact that it's all split into various months. So now you have zero rated supplies, which means all supplies on which you would have not paid tax, being the physical exports. Then you also have deemed export, which is supplies to SEZ without payment of tax. And of course, you also have certain services on which the recipient is supposed to pay tax under reverse charge mechanism. What are those? Sponsorship services. So like for example, if you're running an event, you have a business and you organize an event, you are getting money for sponsorship. Sponsorship is something which you're not liable to pay tax on. However, the reverse charge mechanism, the recipient or the person who's paid for sponsor would be paying. So you need to report your revenue from sponsorship in row number C. So essentially, the table number 5 is all about turnover, which are not subject to tax. Further, if you go down table number 5, you'll realize that it has got exempted turnover, it has got a nil rated turnover, it has got non-GST supplies. Now, there is always a debate as to what is nil rated, what is exempted, but let's take the next one, which is more obvious. What is non-GST supplies? Non-GST supplies are all supplies which are being kept outside the GST net. So, like for example, if I am a petrochemical company, I would report my sale of petrol and diesel in the non-GST supplies because those are kept outside the GST. If I am a restaurant owner, then I would report my sale of alcohol in a non-GST supplies. If I'm an owner of a hotel, I would report sale of alcohol in non-GST supplies. I would report my sale of food from the restaurant at 5% GST if it applies to me into the exempted one. Rest everything would sit into table number 4, which is taxable. The next parts are very logical and a similar. It follows a similar structure, that credit note and debit note. You report the credit note and debit note, and also the adjustments that you would have done. So essentially, into the second part of the table number 5, table number 5 and table number 4, the difference is only a taxable one and a non-taxable one. Rest, it follows exactly the same structure. And what they are trying to ascertain over here is what is the turnover on which we have claimed the tax is not applicable. And this is something which will get always referred and correlated with the annual revenue. And also each and every line item is going to get scrutinized. Uh, Now, our sense is that as long as you've made a correct disclosure, which means that I have kind of reported it as far as possible, there should not be any charge or suppression. It's important to report all the figures because once you have reported it in the annual return, because you realize that there is a different period of limitation. If they were to say that the information has been suppressed, which is an extended period of limitation, even if I don't file any of it, my taxable liability is not going to change because I would have reported everything correctly in table number 4. But we recommend everything to be disclosed in table number 5 because that helps me to guard against any charges of extended period of limitation where a non-disclosure is the most common ground taken to press for those charges. So really important that we fill up the table 5, and while filling up the table 5, we need to really convince ourselves that whether the tax was really not payable. Okay, so now we move on to the next part of the return, which is the third part of the return, where we are going to disclose the input tax credit. Essentially, input tax credit is the heart of GST because you don't want a tax to apply, but this is something that needs to be reported as well. Now, quite interestingly, if you really look at, for the first time since we started discussing, there is an auto population coming in. So what they're going to do is they're going to take your GSTR-9B input tax credit and auto populate it to begin with. This is a sort of reconciliation that they're trying to build, and we'll go a little more detail as to explain you as to what are they trying to build over here. So they're trying to kind of build a reconciliation saying that what have you already submitted. Now please try and understand that the first part is going to get filled up. The next part is all something that we have to declare, which means these are all free fields. You can enter any information that you want. However, all of it has to tie up, logically speaking. If it is not tying up, uh, it's a situation where something has gone wrong somewhere. Either we have declared more in the GSTR-3B or we have declared less in the GSTR-3B, and we'll talk about it, how to handle the situation. But if you really look at the breakups are very interesting because for the first time, they're asking for inputs, they're asking for capital goods, and they're also asking for the input services. Now, if you look at 3B, 3B has none of those information, right? So you really need to do some bit of a kind of working to arrive at what are inputs, what are capital goods, and what are input services. In my experience, I've seen a lot of people saying that the relevance has been lost. Maybe yes, but for the purpose of reporting, there is some bit of a working that needs to be done to derive those figures. Uh, but what is more comforting is all of this information has already been reported to 3B. It's basically synthesization of information or possibly a breakup of information that has been asked for. The last one is, of course, import of services, excluding supplies from SEZ. So you kind of also include what are the ones on which you have paid tax under the reverse charge mechanism, and rest of it is all domestic purchase as well as uh, the imported supply. So B, C, D is all about domestic purchases. E is about the imported goods, and F is about imported services. So on this table, what needs to be watched out for is they're trying to do a auto population and then asking for the breakup. Number one. Number two, there is a breakup that is required in terms of the input capital goods and input services. Okay, so let's go forward and see what else they have, right? So then they're also asking for what is the credit which has been received from through ISD. So ISD is basically where somebody else, some other states have received the services, and now it is getting transferred within the same entity. So you have a credit coming from the other location. Then you also have any amount reclaimed under the provision of this act, and then you do a subtotal. Now, when you do a subtotal, the subtotal B to H, and I'll just go back to B, you will realize that what they are trying to add is the total figure as per the details that you have just provided. And then in the next row, which is row number J, they are trying to find the difference between the 3B and actual. So here is it in the return, that sort of a reconciliation, not on a line by line item basis, but on an overall basis as to what was there in 3B and what is it there as per the detail furnished. Interestingly, the column number J, if you really look at the construct of the balance column, it's not, you will not be able to see it until I go to table number 8, where they will come to a figure which is called the lapse credit, which means they will ultimately use this to tell you what is the total credit that you are automatically losing because of the fact that you have claimed an excess credit in any part of the return. And I'll just come to it in a while. So just maintain the flow now. Maintaining the flow now, we will also have to disclose what is a transitional credit through Tran 1. Tran 1 is basically the pre-GST credit, and also the Tran 2, which is the sale of a pre-GST stock. Then ITC 01 and ITC 02. ITC 01 is where the registration has been obtained. However, the goods have been received with GST, so you report it in ITC 01. And then you have ITC 02, which is typically applicable where you do a transfer of business, and as a result of which the credit also gets transferred. So these are additional credit that is going to come to you other than the invoices. And then you add and say what is the total available credit, which is 6O. So if you look at O, the O is the total credit that you have availed. Now here, when I say total credit that you have availed, it has nothing to do with 3B. 3B at row number J, we just have casted a number, which is the difference between what has been claimed as per 3B and what is the actual number that you have disclosed so far. So the total ITC credit comes into row number O, and then in table number 7 or the row number 7, these are all reversals which are going to happen. So again, a practical point to consider over here is a lot of people only report the eligible credit in 3B. They don't report anything ineligible. Some people fear that if I report something which is ineligible, perhaps I'm making too much disclosure. But now you'll face a challenge, because either you can continue the same thing, which means from the top table, which is table number 6, you net it off against the eligible, or if you have not, then you have to add the ineligible credit, which is going to show a mismatch between what has been reported in 3B and what you want to report in the annual return. This is again going to be a practical challenge, but like I said, some people also believe in making the full disclosure, so any future charge against not disclosure can be protected against. So in terms of again the construct of the table, you specify the non-deductions or non-deductible, So as per rule 37 is 100 days. So any payment which has not been invoice payment which has not been made in 180 days, you reverse that. Then as per rule 39, which talks about ISD credit, which is not going to get distributed, so you reverse that as well, because whatever that you distribute, it goes out of your pocket. But if you're not going to distribute, you have to write it off. Then rule 42 tells about the proportional credit if you're providing a taxable and exempt services. Like for example, in case of a hotel, where the restaurant sale at a 5%, if 5% is applicable, because you also have hotel which are at 18%. But let's talk about 5% hotel sales, restaurant sale, and the alcohol sales are not subject to GST. However, your room, your banquets are all subject to GST. So you do a proportional credit. So you write off the part attributable to the exempt supplies under row number D, which is as per rule, in row number C, which is as per rule 42. 43 is also on account of exempt supplies attributable to the capital goods. So 42 is for input and input services, 43 is as for the capital goods. And 17.5 are all those services, 17 and sub-rule 5 are all those services, which is in row number E, which pertains to the negative list on which credit is not allowed. So like for example, rent a cab or the club membership. Now, again, some people don't report, would not want to report it, but if you kind of look at the construct of the return, all of it needs to be reported. And we have a similar structure in case of 3B as well, which asks you as to what is the number on account or number of credit which you're not aware. Now the interesting difference which one can make between a 3B and this return is kind of taking the whole universe and then separating what is not allowed as credit, which means you first do a grand total and then you kind of do an elimination. In 3B, it appears that there is a standalone information for credit not availed, while there is another one where the credit is eligible. So there may be a little bit of a difference in terms of 3B and here in this return. If I go to the next part of it, the next part of the return, which is other input tax credit related information. Now this is more or less sort of a reconciliation, right? And now here is where the big item is going to come in. The missing item is going to come in, which is GSTR-9A. Now, what is GSTR-9A? GSTR-9A is a statement which gets generated when our suppliers provide details of the invoices which are raised on us. So it is basically a counterparty information or a vendor related information basis which GSTR-9A is prepared. And GSTR-9A is a sort of 26A statement, the income tax 26A statement, which all of us are familiar with, especially as salary taxpayers, which reflects the total amount of tax deducted and parked into our account, whether by an employee or by way of a bank, employer or bank. So GSTR-9A is a statement which discloses the total credit reported into a particular GSTN. So now the GSTR-9A information comes in here, and further the reverse charge liability, because the reverse charge liability is something which is not going to come in. Now what they are trying to calculate is from the GSTR-9A and from the information. So GSTR-9A is what has been already submitted. Out of the GSTR-9A, how much is that you have declared to be your credit, and the balance is something in effect you are declaring those are not your credit. Just to kind of repeat this again, so I have a GSTR-9A, which means against my GST, and a lot of the suppliers have raised invoice and parked credit. So I have credit on account of rent a cab, I have credit on account of consulting, I have credit on account of the manpower supply. So I have a lot of credit which are parked on GSTR-9A. Now I know as a matter of fact that I am not eligible to take credit of rent a cab. So I will deduct the rent a cab from my total eligible credit, and the balance eligible credit is going to come into this table A below line item from serial number B onwards, which will ultimately lead to the rent a cab being left at column K as ineligible credit, which is going to lapse in the year. So here is a sort of a mini reconciliation, I would say, and it is not a full-fledged reconciliation. It's not a line item wise reconciliation, but sort of a reconciliation between what you're claiming and what your GSTR-9A is showing. Okay, so the point to note is that we must look at GSTR-2A, and then see what is it that we are claiming. What we do not know at this point in time is what happens. So there are two possibilities that can arise. One is that in my credit claim, I have claimed lesser credit than what is there in my GSTR-2A, which means GSTR-2A has got all the information, but I do not want to claim credit of all of it because either I'm not very confident about it, or for that matter, I know these are credit are not admissible. Like for example, club, like for example, health insurance, like for example, rent a cab, uh, and those are something which I'll never be able to, never would want to claim because they're not allowed under law. So in those situations, my GSTR-2A balance is going to be always higher than what I've already claimed, which will lead some figure into row number K as the amount which has got lapsed. What happens if it is other way around? Which means what happens if I am trying to claim more credit than what my GSTR-2A is showing? Now here, if you really look at it, two things can have happened. Two things could have happened. That either my supplier would not have reported, which means my GSTR-2A number is low. However, my credit number is all right. So that is how much my GSTR-2A number should at least have been. Or I'm claiming more credit than what my supplier has paid tax. Now, we do not know what is going to happen in those situations where the form will work, which means whether you'll be able to submit the return, or they will say that no, you cannot go anything beyond GSTR-2A. If they say that if you cannot go anything beyond GSTR-2A, really there'll be some bit of a pain, especially in those cases where there has been a big miss out. But we'll have to wait and see how it works. Or they would say that you are allowed to claim only till what GSTR-2A is showing. So the question around reconciliation, the question around reconciliation, we need to do a reconciliation, if not on a line item level basis, but on an overall basis. But ultimately, it's good to do a line item basis. Okay, there are two line items I want to kind of call out specifically: row number E and row number F. Now, row number E is ITC available but not avail, which means this is a line item in which though the credit is allowed, but I have decided not to take credit. And row number F is ITC avail but ineligible, which means other way around. The ITC was available, but it is ineligible, which means it is not allowed. So if you have certain items on which you don't want to claim credit because of whatever reason, you can put it in E, not in F. F is something which are clearly not eligible out of D. So this is a sort of a reconciliation, and the balance is something which they're saying it is going to lapse in the next financial year, which means you cannot carry it forward because you have declared what is the total credit that you are eligible for. Anything in excess is going to get lapsed. Okay, now coming to the other part, which is the tax payment. Now we are on the fourth part of the return structure, which is about the details of tax paid. This is pretty much again it's pretty common and it's pretty self-explanatory that whatever tax and in whatever under whatever head, late payment, penalty, interest, all of it needs to be reported. Uh, what we need to remember is there is no payment happening through this return. There is no payment. There is no facility to credit the cash ledger and put an amount over here. This needs to be disclosed based on whatever that has already happened. Okay, now we are left with the other particulars. Here we have kind of plotted some of the typical ones. Now these are the ones that we kind of called out in the beginning. Look at row number 10 and row number 11. Supplies of tax declared through amendments, net of debit notes. Now these are the ones which are April to September reporting. Now, for example, if you have missed out on anything, then this is where we need to report during April to September returns, which practically should have been filed between July to March, respective months. Reversal of credit availed during the previous year. So essentially, this is going to kind of lead you to a number of a differential tax. Now, let's look at where the differential came from, right? We have already reported what the tax was payable. But what happens is when you, let's suppose I missed out an invoice for the month of March, and I realize it in the month of April. So what do I do? So as per the law, I need to report it before September 2018. So I have reported in the month of April, which got filed in the month of May. Now, because I have reported in the month of April, the tax on the corresponding transaction also got paid in the month of April, right? It could not have got paid in the month of March. That is a number that you need to calculate and report it over here. So what they are trying to find out is something like a past period adjustment, which is done in the current financial year, right? And interesting part is they are also asking us to report what is the differential tax payment on account of 1011 and 1011 in all the adjustments that we're talking about, right? So this is something that you'll have to look at the GSTR 3B and see what are the invoices which are not pertaining to the corresponding financial year, which has been reported in the current financial year. Of course, you can do it till 30th of September. And what is the net tax liability on account of those transactions and report it in table number 14. So table number row number 10 and 11 is about adjustments. Similarly, table number 12 and 13 is all account of ITC, which means suppose if you have a similar example, if you have a raw supplier invoice which you forgot to report it in the month of March, you report in the month of April, so you put it under row number 12. And then whatever differential tax liability that comes up, you report it here. Now, this differential tax liability, again, I'm repeating, you're never required to pay separately. You pay it along with the corresponding month, but this information needs to be separated out and then reported. Okay. So now the other part which is left, of course, is what is the common, what is the, what are the other information? I mean, miscellaneous information I would call, because these are something which are arising out of the principal computation that we have done so far. What is the total amount of refund claimed? What is the total amount of refund sanctioned? And what is the total amount of refund rejected? And what is the total amount of refund pending? So this gives a snapshot on an annual basis as to what is the refund that is pending, what is the refund that has been claimed, what's the refund that has been not sanctioned so far. If you go down below, there is a similar detail required for the demand on account of taxes. What is the total demand which is made from us? What's the total that has been paid? And what is the total which is pending? Now, that brings us to the last part of the return, or the sixth part of the return, which are some stray bit of an information which the government is trying to collect, but it really doesn't affect our liability, so to speak. Now, this is something which they would do uses as a part of the analytics or part of our data analysis to figure out some specific transactions. Now, those specific transactions could be what is the supplies received from a competition taxpayers. Now, whether reporting or unreporting doesn't kind of really change the tax liability, but the accuracy of the return. So what are the supplies? What are the supplies which are made to job worker? What are the supplies made on the approval basis? So a lot of kind of stray pieces of information. Okay. Now HSN-wise supplies. So HSN-wise supplies, same thing that you would have reported under for GSTR-1. And the next part, which is row number 18, is a new one, which is not there in 3B, and this is an additional piece of information. The input tax credit in terms of HSN, in terms of UQ's HSN code, right? So this is not something that we report in 3B, because 3B is a consolidated number, but you need to break it up in terms of HSN. And also, lastly, the late payment fees which is paid. Okay, so now what is it? So I'll just kind of repeat some typical features. The first part is if you really look at the net ITC available in table A. So what's happening is the difference in approach, right? So 3B, a lot of people file show only the net credit, right? They don't show the gross and the deductible or ineligible credit. There is no facility. There is only an eligible credit. However, if you look at the format, to that extent, there is a mismatch, or maybe there is a difference in approach. This format starts with the fact that what's the gross credit, out of which what is ineligible, and it goes to the eligible. Whereas in case of 3B, you would have reported only eligible. So there is a difference to that extent. Now, What is the supplies from the composition dealers? Supplies from the composition dealers are not required to be reported. However, you have to report it in the current return. HSN summary wise inward supplies, that is also a new requirement, because you don't report it in the 3B. And lastly, difference in ITC as per GSTR-9 in case where the supplier is filing GSTR. So here is a problem, that what happens in cases where I have claimed the credit correctly, but my supplier has not filed his return, and he decides to file after the annual return date, right? So this is clearly going to be not part of GSTR-2A. To that extent, there will always be a mismatch. Okay, so that leaves us with the composition dealers tax. And if you really go into the composition dealers tax return, you will realize that it's the similar structure and similar detailing. However, they don't want details of any input tax rate because there are no input tax rates, so to speak. So while we have mapped out the individual cells and individual rows, where do you get information from? Vis-a-vis GSTR-4, because you don't have the normal GSTR-1, you can perhaps kind of refer to GSTR-4 and kind of see what is the credit, how do you kind of fill up for the composition if you are under composition tax payment. Before just kind of ending the discussion and kind of the explanation, I would just repeat once again what are the key features of annual return. The key features of annual return is you cannot it cannot insert any detail other than what you have already reported in a monthly return. It's critical that whatever transactions that you have for the previous financial year, that needs to be reported in the September month. You do not have any further legally available recourse to report it at a later point in time other than 30th September, even in the annual return. So a lot of people will still believe that annual return is where you do all the adjustment. That's not permitted. You have to do the adjustment in the monthly return, and annual return is just a arithmetical summary. No interest tax late payment can be paid through annual return. New requirement to bifurcate certain items, ITC on capital goods, you've seen this, input services. An annual return once filed cannot be revised. And of course, there is a lack of clarity if you have kind of switched the scheme in between the year. So that's all I had from my side, and happy to take any questions that you have. Yeah.
Great. Thanks, Priyajit. That was detailed. And it looks a little complex to me. I don't really know how complex that will be. But first question that we have is from Kailash Munra. He writes, if we file the September 18 GSTR-1, and after that we came to know that some invoices are left out from declaring the same in GSTR-1 for the period of July 17 to March 18.
Right.
Then how to show that in the annual return or in the audit form? I think we touched on this.
Yeah, so we touched on this, but let me tell you the solution, right? And this is not a really a kind of foolproof solution for that matter, but it is just like kind of surviving out of the situation that you are in. Technically speaking, like I said, that you need to do it in September, but if you have not done it, then what will happen is you will do the return, annual return, exactly the way you have done your monthly returns, right? So you don't have any leeway to put in anywhere. But in the annual account audit statement or the reconciliation statement, this invoice is going to be shown as an unreconciled item. Because when the auditor signs it, he will reconcile it with your financial, and that is going to be shown as unreconciled item, and you will have to report it in the corresponding month in which you have discovered, which happens to be after September. So it is going to be an unreconciled item, which is going to be looked at a later point in time. And I would not really want to see too many unreconciled items if I'm able to do everything in September or maybe most
of it. Right. I think the other question where he says, how can revise data in the return? How can we revise data in return modification of data? I think that's it. You can't really.
Yeah, so once you file it, you really cannot do it. What we need to look at is, of course, they'll come up with the save option. So possibly you want to kind of do it in steps. Yeah. So, but in the law, there is no leeway to kind of revise the return, and we still have to wait and see whether they really think it is necessary to come out with a provision.
Right. Says, is there a possibility to adjust B2C credit notes in GSTR-9. And there's a second question which says, what will happen if I take GST ITC in the month of December 17 base, whereas my supplier has failed to include the invoice in GSTR-3B and GSTR-1 in December 17, but filed it in August 18.
I'll take the last question first. And fortunately, the supplier is showing it in the month of August 18. So it really gets into my 2A, because once you have an invoice which is shown it in the month for the reason the month of December, it will kind of show it in my credit pool in GSTR-2A. So it's going to be taken care of. But the first question is there possibility to adjust B2C credit note in GSTR-9? Yes, you can supply. You can kind of report the credit note. There is a section of credit note, and while in GSTR-2, GSTR-1, you would have done a net, which is net of the credit note. So yes, there is a possibility to adjust the credit
Right. So, for name right. That's an interesting question. If there is an error in earlier filed GSTR, error in reporting transaction like details filed in the wrong table, can it be rectified through annual return? If not, does it mean we need to make the same error when repeating when you're doing the annual return?
Yeah, so what we need to realize is annual return is really not a time to kind of review all of it. Annual return is to kind of present a summary of all the returns, and there is, I think, a view that why do we need to do all of it? Because if it is just an arithmetical summary, but Preeti, what you need to do is do everything in the month of September, right? If you are not able to do everything in the month of September, then your annual return and the reconciliation statement, audited GST audit report as we call it, is going to show a mismatch, right? So the way they did annual return is they didn't want to kind of make it another return for that matter, which means you file monthly return and then you kind of make an assessment at the end of the year, which they are doing it for the purpose of the GST audit and unreconciled, right? So it will show as an unreconciled item. Interestingly, even under 9C, which is the reconciliation statement or the audit GST audit statement, there is no facility to pay tax there, right? So you will have to admit it in the ongoing returns. And like we said that you would have heard that the new return format which they are coming up, they will come up with a revision part as well. That's more on cards. But here, as it goes, you will report it in the current month return as an adjustment.
Badrinaran has written, how to claim refund of GST paid on B2C invoices cancelled / written off after payment of GST.
Okay. So this is something that if you kind of refund it, if you kind of refund the money and you want to claim and it's basically a cancelled invoice, and then you will have to kind of either issue a credit note, and the balance is something that you should be able to adjust it. So adjustment is a real possibility. Refund is something which they will possibly not allow, because refunds are only allowed to exporters and zero rated supplies.
So, I think Alok Sharma said what new information we need to file under annual returns as compared to 3BD. I think we already touched that.
Yeah, more to do with input tax credit and more to do with input tax credit related information, as well as please try remember that 2A reconciliation is something that we've never filed, so that's a new piece of information.
Right. Bala Subramaniam asks, we now have an annual audit form. How is it different from the one which was available under the last regime? Do you think the reconciliation bit can be tricky?
So annual audit, annual audit form. You have a so he's referring to 9C perhaps, because that is the annual audit format, and he's not referring to 9A for that matter. See, the way I look at 9C, and we have not covered 9C though, is 9C is a lot simpler than what you used to have under the VAT regime. So VAT regime, when we look at Maharashtra VAT audit report, it was a lot complex. This is a lot simpler. And what you would realize is it's just a reconciliation statement that they're asking, right? And rest everything is in 9A, which we have just discussed. The reconciliation, it depends what you're referring to. If you're referring to a reconciliation of 3B, it is going to be easy. But if you're referring to GSTR 2A, it can really take some time. And more specifically, the fact that now the reconciliation, now your annual return itself is going to show the quantum of unreconciled amount. So I think this is going to be a little bit of a pain area, especially because we have never done this before.
Right. Sagar says, can a exclusive unit purchase from unregistered dealer? And if yes, I don't think it's related to this, but up to you.
Yeah.
If yes, then under RCM refund can be claimed by the unit.
Okay, so as far as RCM is concerned, and I'm registered, unregistered, you have RCM, the provision has been suspended. So we don't have that situation. Now, if you have already paid tax before the provision was suspended in the month of October, if I remember correctly, then you really need to look at whether you have filed the letter of undertaking. If you have filed letter of undertaking, then you can take a refund, because ultimately the special economic zone would have exported it. And if you also look at that, if you have already not and it is something which is covered under specified services. If it is covered under specified services of the special economic zone, is entitled to buy without payment of taxes, then you don't have to pay tax under reverse charge mechanism.
Right. Anand Narayan says, what if I make a mistake while doing the annual return and discover it only later? Can I make changes in the annual return at a later date? Is there any penalty for genuine mistakes?
So yeah, the facility of annual return is they've not kind of given, and it's a little bit of a practical question, because there is no penalty in terms of the penalty is only for the purpose of only in case of a delayed filing or non-filing, for that matter. If there is a mistake in it, and I would kind of tend to give a liberal interpretation to say that if the mistake can be explained, I think it's pretty much somebody can understand it. But if the mistake is more to do with credit or exempt turnover, then possibly good chance that the tax authorities would take a view more in terms of a non-disclosure and a willful mistake suppression than anything else. So yes, I would kind of make a provision for the genuine mistakes, but really I want to be careful on the credit as well as the exempt turnover part.
Right. So Alok says, how much will your CA charge to audit accounts? If I already have a CA, can he give the audit certificate, or does it need to be a new CA?
Well, difficult to kind of give a rate chart as to how much it will cost, but yes, if you already have an auditor, he can give you. If you do not have, you can kind of have any of those people do it for you. Look at the list of eligible people who can do it, and should be okay for you to engage them and do this for you.
Right. So Govind has a question pertaining to your slide. It says, if we have, so what is the second option? What is the second option? You told that GSTR-9A credit is less than the credit we have taken as per physical invoice we had. The supplier not yet filed the invoice in respective month.
Yeah, so what he's referring to is the fact that we have taken credit based on the physical copies of invoices that we have. However, the supplier has not uploaded his return, or he's not kind of done the correct reporting. So my GSTR-9A doesn't have enough credit. However, as per me, the credit should have been there in GSTR-9A. Again, I mean, what we are not very clear is in an accurate situation. See, what will happen is, in case you have few suppliers doing it, then there's a netting off that naturally will happen, because some of it you'll not claim credit, some of it you'll claim credit. So possibly it will not pose challenge for most of them. But if you have too many suppliers getting into it, then of course what we need to look at is, are they going to lock your credit to the extent of 2A, or are they going to allow you the credit, and then you can perhaps ask the supplier. So I guess that's why we are recommending a reconciliation exercise to be undertaken to kind of minimize that gap.
Right. Do you see reporting of reverse charge mechanism under section 94, which would be for expenses not matching the turnover? What happens if some RCM items were left out? Also covered in 3B of September and included in annual returns. Anything on RCM?
Well, there is a reporting in terms of the reverse charge mechanism. And like I said, that if you have omitted anything in any of the return, you'll have to do it in the month of September. If you cannot do it in the month of September, then you will have to go back to, I will just go back to the table. Perhaps you will see this. Yeah, so here is this. Okay, so 10, 11, 12, 13, this is where it should ideally figure in if you do it before September.
Okay. Right. We are completely out of time. Last question. Okay, we'll take the last question from Veena. She says, what if annual accounts doesn't match with GSTR-9A? Any solution?
Well, 9A. Okay, so if you look at, I think she's
annual accounts turnover, I think she mentioned.
Yeah, so annual accounts turnover will never match with 9A for a reason that there are accrual entries, there are a lot of adjustment that's going to happen. And I think your question is more specific to 9C, which is the reconciliation statement. Look at the reconciliation statement. This return is just a summation of what we've already reported. If you look at 9C, that's where it starts from the revenue reported in the state, and then it goes to deduct the accrual, it goes to deduct non-GST. So all of it's something which is going to get kind of reflected in 9C, and that's going to be more relevant for a situation that you are in to explain. But having said that, I don't think many people's turnover as per return is going to exactly match with the return, and that's what 9C is going to bring about.
Great. So we completely out of time. We would have loved to tackle more questions. I clearly see there is a lot of confusion still around the annual returns, and probably we can have another session closer to the return filing dates, so that any other queries that pop up within that time, we can get that answered as well. Priyajit, thank you so much for running us through the return form in such detail, and real pleasure having you here.
Right. Thank you.